In this week's video, we'll review the latest charts and data to help us answer the question: stocks in 2025, normal volatility or the start of something much worse? If we look back roughly a year ago, this is the title slide for the January 19th, 2024 video, you can see that we entered the year from a research perspective with an optimistic outlook. And for the most part, that was in stark contrast to most of the full year forecast for 2024. From a recent Bloomberg article, strategists had predicted a modest year for the U.S. stock benchmark. And as we all know, that's not the way it turned out. The S&P 500 index finished the year up 23.31%, our average account up 22.88%, our median account up 22.67%. And you can see from this graphic here, relative to different sectors and individual stocks in the S&P 500, a very high percentage of them in 2024 underperformed the index, and a very small percentage of them outperformed. Our goal is always to take what the market is willing to give, and we accomplish that in 2024. From an asset allocation perspective, we worked very hard to keep our cash levels low in 2024 based on the data and charts in front of us. And thankfully, our allocation did not include bonds. TLT, long-term treasury bonds, down 8.08% for the full year. IEF, U.S. Treasury bonds, intermediate term, down roughly 0.6%. We also covered numerous charts during the year, including this chart dated March 22nd, 2024, that told us we should take a very measured approach relative to small caps. And at least for 2024, that worked out well because you can see IWM small caps significantly underperformed the S&P 500. Now, roughly a year ago in that same January 19th video, we said the primary trend remains favorable. And during the course of the year, we should expect normal volatility, pullbacks, or corrections. And in this environment, what we're concerned about, and what we were concerned about a year ago, is the value of our positions in several years. Not over the next 3 days, not over the next 3 weeks, not over the next 3 months. The CNBC screenshot on the left side of your screen from late December, Russell 2000 on pace for its worst month since September 2022. That doesn't sound particularly bullish. We had mentioned on Twitter that it was possible that we were going to cover the 3-month to 10-year yield curve in this week's video. We're going to push that out because the markets have been a little bit unstable and volatile in recent weeks. We know from a historical perspective, it's extremely important that we do not become bullishly complacent. Because historically, the declines in the S&P 500 index, the drawdowns, can be extremely painful in a typical bear market, and even more so in bear markets that are coupled with a U.S. economic recession. So we always want to try to take what the market's willing to give, but we want to do so with a skeptical eye. Lower right-hand corner of your screen, hypothetically, if you had a $5 million portfolio during the drawdown in 1998, from the S&P 500's peak to the low, you would have lost approximately $1 million during that drawdown. It's always good to understand the worst case scenario. For the most part, historically, that's the 1929 to 1932 window where the Dow Jones Industrial Average lost approximately 89% of its value. Hypothetically, if you're fortunate enough to have a $5 million portfolio, you do not want to see the drawdown take that number down to approximately 540,000, hypothetically. So even when things are going well, we always want to have in the back of our mind, how are we going to handle it from a psychological, strategic, and tactical perspective when things inevitably become more difficult and more volatile? And it may seem crazy to think about drawdowns in the order of magnitude of 89% or 56% or 49%. These are all drawdowns that happened in the real world. And if you're experienced in the markets, you know if it's happened before, It can and most likely will happen again at some point. Even recently, the drawdowns in Bitcoin have been beyond gut-wrenching. The drawdown between December 2017 and December 2018, somewhere in the order of magnitude of 83%. The drawdown between November 2021 and November 2022, somewhere in the neighborhood of 76 or 77%. Just some simple reminders to help us with this topic. Our job as risk managers is to focus on what's important now. And right now, we want to make sure that we're paying close attention and we don't get caught off guard by some type of significant bearish event. Thus, let's take a look at some thoughts about 2025 and beyond, and then water test them using January 2025 charts. Experience counts in the markets and in life. January 2nd quotes from Ed Yardeni, an economist. I'm very optimistic on the earnings outlook because I'm optimistic on the outlook for the economy. I think we're going to see better than expected productivity growth. I'm using $285 a share for the S&P 500, and as a result, I'm looking for the S&P 500 to go up along with earnings rather than valuation. And I think it can get to 7,000 by the end of the year, but it's not going to go up in a straight line. And I think in the next few weeks, things are going to be somewhat bumpy. So we want to make sure somewhat bumpy doesn't turn into extremely bumpy, catching us off guard. Some other topics from Yardeni that would align with the bullish case. A lot of my baby boom friends are retiring and they're sitting on $75 trillion of net worth. They're going to have a negative savings rate and they're going to spend it. Big part of that, required minimum distributions from IRAs and 401ks. You're forced to take the money out, forced to pay taxes on it, and hence the probability of spending it goes up significantly. Lower portion of your screen. Since 2015, productivity growth has increased from 0.5% at an annual rate to 2%. So it's quadrupled already. But 2% is kind of the historical average. And I think we're going to do 3% over the next couple of years. So rather than look back and spend a lot of time on 2024, we're going to focus on this question. Do present-day charts align with or contradict this 2025 outlook, a bullish outlook? Or do present-day charts point to the early stages of a recession and devastating bear market? After reviewing a wide array of charts on Thursday evening, it helped us better understand the market's current risk-reward profile from a short-term perspective, an intermediate-term perspective, and long-term perspective. It's a daily chart of the S&P 500. Anchored volume weighted average price lines are the colored lines here. This is the COVID low down here, lower left-hand corner of your screen. This is September of 2021. This is the early stages of the 2022 bear market. This is early January of 2022. And in the early stages of the bear market, you can see the S&P 500 started to violate these anchored volume weighted average price lines from roughly a year ago at that time. If we look at similar lines in the present day, this blue line here, roughly a year ago, this purple line here, roughly a year ago, this is January of 2024. Here, if we follow that forward, the market held a logical area here in April of 2024, held in the same basic area in August of 2024, and right now, unlike January of 2022, when things got dicey very, very quickly, even during Thursday's session, a volatile session on January 2nd, the S&P 500 was trading up here, really nowhere near this line, similar to these lines here in 2022. And during Thursday's session, there were numerous reference points. This high here in the S&P 500 from July of 2024, price was still above it. What once acted as resistance may now act as support. You can see that was the case here. And here we were trading well above that. And we're also above this upward sloping trend line that dates back to that COVID low. If volatility continues in subsequent sessions, This is being recorded during the session on Friday, January 4th. This range in here represents an area of potential support, allowing us to try to be patient. Very similar situation, NASDAQ Composite early in 2022. This is the look that we would want to avoid. The NASDAQ Composite early in 2022 started to slice through those anchored volume weighted average price lines dating back 10 to 16 months. If we look at a similar line in the present day, this is approximately 10 months ago. You can see during Thursday's volatile session, we were well above that orange line, telling us that the trend in the present day appears to be stronger than the trend here in January of 2022. And if we zoom in on the same chart, again, all of these charts are from Thursday's session, you can get a better idea of these areas of possible support in here, and price remained well above them on January 2nd. You can pause your video player or find this in our Twitter feed relative to the Santa Claus Rally and subsequent S&P 500 returns. There's another chart that tells us to try to be patient. The NASDAQ relative to the NYSE Composite still has a favorable setup. It really doesn't look anything right now like January of 2022. During Thursday's session, we were well above these lines from approximately 13 months ago. That was not the case in January of 2022. As we've covered in the past, we have a lot of ratio charts that have a left shoulder, head, and right shoulder look to form, for the most part, the characteristics of a bullish inverted head and shoulders pattern with a bullish upward sloping neckline. Recent consolidation is taking place above this level here that acted as resistance in Q4 of 2021. All of these areas down here could act as potential support, helping us remain patient as long as the charts allow. Compare and contrast the look of the 50-day moving average in blue and the 200-day moving average in red in early 2022 for the NASDAQ relative to the NYSE Composite. Compare this to the much more constructive look in the present day. And you can see again the ratio is above this level here that acted as resistance in late 2021. Right now the ratio is above an upward sloping 50-day in blue and an upward sloping 200-day in red. And if we look at the NASDAQ relative to the S&P 500, a lot of potential support down here from the anchored volume weighted average price lines. The ratio remains above these anchored volume weighted average price lines. And you'll notice the lines are trying to turn back up. They're definitely not sloping down at this point. Again, allowing us to try to remain patient with the reemergence of leadership in the NASDAQ Composite relative to the S&P 500. If you look at the True Strength Index down here, the NASDAQ Composite relative to the S&P 500, you can see momentum was waning 2021 into 2022. In recent months, on the right side of your screen, TSI has been improving. The recent downdraft here in late 2024 held above the zero line. It's positive for the bullish trend. And again, a lot of potential support below the ratio as it sat on January 2nd, 2025. The right side of your screen looks a lot better than this troubling look here in January of 2022. If we look at a weekly version of the same chart, we're looking at the 10, 20, and 40-week moving averages. You can see they have a concerning look here in January of 2022. This, with blue, the fastest moving average on the bottom, really doesn't look anything like January 2nd, 2025. If we draw a straight line from that 10-week moving average from here to where it is in the present day, you can see it's an upward sloping line. If we did that in 2021, heading into 2022, it was a downward sloping line. From this point here to this point here, compare that with this point here to this point here. You have a wide variety of charts that have possible support relatively close by. This is priced during Thursday's session. Even if we come all the way back here on the Dow Jones Consumer Services Index, we would still be maintaining this bullish breakout here from 2024. So all of the recent consolidation is occurring above this consolidation box and above an upward sloping 200-week moving average in red. We have numerous looks, including the blue box on your screen, that make it easier to remain prudently patient, which is significantly different from blind, I've already made up my mind in advance, buy and hold. Blind, I've already made up my mind in advance, buy and hold can be very, very painful if you've worked your entire life to build a substantial portfolio. S&P 500 as of the close on January 2nd, we came back during the session to the election gap that we referenced on our Twitter or X feed. This tweet is dated January 1st, 2025. The purpose of this tweet was to help us understand in advance if the market became volatile early in the year that we have reasonable reference points relatively close by, including numerous charts with the gap here from the election. This is early November of this year. All of this consolidation over here also taking place above an upward sloping 150-day moving average in orange, and that's where the market made a stand in August of last year. Again, this is being recorded during the session on Friday, and at least in the short run, the markets are trying to make a stand near a logical area. We've covered this chart numerous times. The chart on your screen is dated December 31st, 2024, just a few short days ago. When the technical data for the NASDAQ starts to deteriorate like this in early 2008, that's concerning. That's not what we have here in the present day. We still have a look where we're trying to break out of a long-term consolidation box. And typically from a longer-term perspective, like this box here in 2016, it means from a longer-term perspective, the odds tend to favor bullish outcomes over bearish outcomes. If the look of this chart here morphs into something more like this relative to the moving averages on your screen, concerns would increase. But right now, it looks like the data made a stand at a logical and bullish level. You can make an argument that this look here is similar to this look here in 2013. Stocks performed well in 2013, 2014, into May of 2015. So weekly cloud of the S&P 500. If you pause your video player, we're checking a lot of the bearish boxes here in early 2022. That's not the case as of the close on Thursday, January 2nd. NASDAQ 100 came back to a logical area during Thursday's session. Intraday on Friday, it was trying to make a stand near a logical area. The same thing can be said for the NASDAQ 100. That's the chart on your screen. There are numerous areas of potential support if the market continues to be weak, including an upward sloping 200-day moving average in red. During Friday's session, we were above the election gap here and above this gap down here from July of 2024. This is still a valid reference point, and this is still a valid reference point. Thus far, we're holding above those reference points. This helps us with the longer-term perspective. This is the NASDAQ 100 weekly with the 30-week moving average in blue, the 40-week in red, and the 50-week in green. That's a full-bore bullish look with price above all the moving averages. Blue, the fastest moving average, is on top. Green, the slowest moving average, is on the bottom. As of a close on Thursday, RSI still holding above 50 on the weekly chart. We're still above this upward sloping trend line that dates back to this low in October of 2023. Similar volatility here in 2024. Normal consolidation, normal give back look the market held. Similar look in here. Thus far, we haven't seen anything that's too alarming. Bearish probabilities would increase if the NASDAQ 100 weekly breaks into this area here. The longer it stayed there, the more concerning, hypothetically, it would become. It's another good one to pause your video player. Look at the bullish points and the bearish points up here. and then compare them to early 2022 to early 2025, checking all of the bullish boxes here on the ratio of high-yield bonds to 1 to 3 month T-bills, so riskier, higher-yielding bonds relative to more conservative and lower-yielding T-bills. This is a risk-off look here in 2022, not what we have in early 2025. Charts as of the close on Thursday, January 2nd. For the full week during the session on Friday, January 3rd, the ratio was up 0.49%, in stark contrast to the look of the ratio here in January of 2022. Similar situation here, in stark contrast to the look of HYG, high-yield bonds in isolation, in Q1 of 2022. All of this recent consolidation taking place above an upward-sloping 200-week moving average. During the session on Friday, unlike Q1 of 2022, for the full week, HYG was up 0.58%. This is the risk-off look in leveraged or risky loans that we want to avoid in the credit markets. If we zoom in, this is BKLN leveraged loans during the topping process in 2021, 2022. This is February of 2022 in the early stages of the bear market. This is the exact same chart during the volatile session on Thursday, January 2nd. This is the technology sector for the S&P 500 relative to the equal weight S&P 500 ETF RSP, which includes all sectors, including XLK, the tech sector. What once acted as resistance, may now act as support. The ratio is still well above the dotted line and above these upward sloping anchored volume weighted average price lines, including the red line that dates back to the low here in early 2023, late 2022. We're also holding above the anchored volume weighted average price line tied to this relative high in July and this low here later in the summer in 2024. Full bore bullish look with the 30, 40, and 50-week moving averages for the S&P 400 mid-cap index. This long-term period of consolidation, or this blue consolidation box, is an area that could provide possible strong support should mid-caps come back down into this area and test the box. Bitcoin relative to the US dollar, it has a risk-on look in the present day. If the Dow Jones Composite, the broad Dow Jones Composite, continues to be volatile, a lot of potential support below price down here. Another chart that gives us some room to be patient, the S&P Composite 1500 Index above an upward sloping 30, 40, and 50-week moving average, also holding in this area here, price still above the upward sloping trend line that dates back to October of 2023. If we look at the daily version as of a close on Thursday, holding above an upward sloping 100-day in red, and also holding above the gap here from the election, referenced in this tweet from New Year's Day at 10:25 a.m. Eastern Time. During the session on Thursday, the NASDAQ Composite above this area here, what once acted as resistance in July of last year, may now act as support, still above the upward sloping trend line that dates back to this low here in late October of 2023. Price held here. We're still above it here. Concerns would increase. The NASDAQ gets into this area here. The longer it stayed there, hypothetically, the more concerning it would become. This is during Thursday's session. Intraday on Friday, the NASDAQ was rallying, still above these reference points. Also still above the election gap up here if we move to a chart with high-low close bars. Here's the gap up, and here's the gap down from last summer, telling us this is an important area. It intersects with that upward sloping trend line. Riskier high-yield bonds in isolation, early 2022 really doesn't look anything like early 2025. And that speaks to market participants expectations about future economic and market outcomes, and their fear or lack thereof of increasing bond defaults. This is the risk-off look in the IPO ETF in January of 2022. This is the same chart as of the close on Thursday, January 2nd, checking all of the bullish boxes on the weekly cloud. There's an explanation of this chart earlier in the video from that tweet, or you can find it on our Twitter/X feed at Shivako Capital. Here's the spelling down here. This still looks like a bullish breakout in favor of growth, favorable growth expectations relative to fear of increasing inflation. Doesn't mean the market's not concerned about inflation. It's just that on a relative basis, the market's expecting inflation to be muted enough in the context of anticipated growth that good things can happen. This is the chart during this session on Thursday, January 2nd. There's a smaller version of the same chart during the session at 1:43 p.m. Eastern Time on Friday, January 3rd. The ratio was up 0.72% and still well above this level here. We're not making any assumptions about what happens on any of these charts in the next 3 days, 3 weeks, or 3 months. Commentary is based on the chart in front of us. We'll continue to take it day by day. There's a little blurb about the Russell 1000 index. And if we look at the Russell 1000 growth index relative to lower risk or defensive-oriented 1 to 3 year treasuries, SHY in the ETF world, this is the risk-off look here, plunging in January of 2022. This is the look as of the close on Thursday, January 2nd. This still looks a lot better than this. Similar situation here, concerning look 2015, concerning look 2018. If you know your stock market history, 2015, not a good time for the stock market, especially walking forward from May of 2015 into February of 2016. A lot of volatility in 2018 and a painful plunge that ended on Christmas Eve 2018. This is a concerning look in corporate bonds relative to treasuries, LQD relative to IEF. This is the COVID crash. You can see the ratio relative to the 200-day moving average in green. We all know what happened in 2022. This is a risk-off look. This is the same ratio trading above an upward sloping 200-day moving average in green as of the close on Thursday, January 2nd. Showed this chart numerous times. It's the NASDAQ 100 monthly cloud as of January 2nd, the close. It still has a risk-on look, and it really doesn't look anything like this concerning rollover look in the dot-com bust bear market, or anything like this concerning rollover look in the relatively early stages of the financial crisis bear market. And it does look a lot more like the period following the major low from March of 2009. We covered this chart in December of 2023. It leaned bullish, and it's been helpful right up until January of 2025. This is the risk-off look here, plunging ratio of the triple Qs relative to XLE, the S&P 500 energy sector. So basically, the NASDAQ 100 relative to energy stocks, plunging when market participants are concerned about inflation in 2022, a much improved look here in December of 2023. Here's the same chart in the present day. This is as of the close on January 2nd. This is the look that we want to avoid. Look at the ratio relative to the moving averages, and look at the same ratio relative to the same moving averages in early 2025. As CHG large cap growth stocks during Thursday's session, or as of the close on Thursday, January 2nd, still trading above that gap up from the election, which also corresponds to this area of resistance in July of 2024. It's relatively easy to remain patient as long as growth stocks hold this area. A little bit of an overshoot, not a big problem, because you've still got an upward sloping 190-day moving average here, where the market held in August of last year. And obviously the 200-day moving average, would be in here somewhere as well. If we look at the daily chart of VTV relative to SCHG, value stocks killed growth stocks during the bear market in 2022. This ratio very, very close to having a full-bore bearish look against value and favoring growth. We really don't have anything in hand in the present day that contradicts the demographically induced secular bull market that could last until 2035. Demographics align nicely relative to goals in 2025. Number one on the list in this poll, saving more. Even if really good things are going to happen longer term, we know volatility is 100% normal and to be expected, and it can be relatively painful, even within the context of a secular bull market. The data that we have in hand still allows us to think long term. Data on your screen as of the session intraday on January 3rd, 2025. Our models were extremely helpful for the entire calendar year. It's a slide that we covered approximately a year ago on January 4th, 2024. You could possibly make the argument that there's a case for a thesis related to a quadruple economic boom. The baby boomers have a ton of money in tax-deferred accounts. They've got RMDs coming in future years. We have two massive generations, the millennials, Generation Y, and Generation Z right behind them, that are providing the United States with very favorable demographics in terms of workers between the age of 18 years old and 54 years old. And the millennials are in that sweet spot between 34 and 54, their peak earning and spending years. We've also got technology advancements, including AI, that are helping drive productivity. Pause your video player here. Good set of data from Larry. Dean Christians from Sentiment Trader, something that just happened in the energy sector. 1 year later, the S&P 500 typical return about 18%. The tech sector, almost 31%. And look at all the sectors, helping us keep an open mind about better than expected outcomes, despite numerous legitimate concerns over the past few weeks or months. The market can't be in full-bore bull mode in terms of all the data 100% of the time. It would be too easy. But we don't want to get stuck on any story or thesis, and understanding the historical context relative to drawdowns can help us keep an open mind. We want to sincerely thank our clients for their business and loyalty in 2024, and we look forward to working with them in 2025. One of the reasons that we are not accepting new clients currently and have not been accepting new clients, we're trying to free up some time to help our existing clients. If you are an existing client and there's something you think we can help you with in 2025, don't hesitate to shoot us an email. An example would be, if you're concerned about your retirement projections, we're happy to run some numbers for you. Having said all of that, our primary task is and will always be paying attention to the markets and managing our accounts. At the close on Friday, the S&P 500 finished up 73 points. Thus, we haven't seen anything yet that's overly alarming. Thus, from a longer-term perspective, the bullet points from a year ago that were helpful still apply today. Primary trend, unquestionably favorable. And that speaks to the longer-term outlook. Probably fair to say the outlook for 2025 will include higher volatility, probably going to be a little bit more difficult to navigate between point A and point B. So we should expect normal volatility pullbacks and corrections, and we can still focus on the value of our positions in several years. During 2024, we were outperforming the market numerous times. We see no reason to change horses, thus, wouldn't be surprising if that outperformance kicked back into gear sometime in 2025 or 2026. And we all know the only way that we can use all of this effectively as if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.